Good afternoon, everyone, and thank you for joining us today. It is my pleasure to welcome you all to this session where we have the entire management team of Green Lantern Capital with us, Mr. Nilesh Doshi, Mr. Abhishek Bharadwaj, and Mr. Pradeep Gokhale. Together, we look forward to sharing our investment strategy and discussing how we are navigating the current environment with particular focus on both macroeconomic and microeconomic factors. We appreciate your presence and interest and hope you find this today's discussion insightful and engaging. Thank you, everyone. And over to you, sir.
Yeah, thank you all for joining on this call. Uh, Typically, yes, we keep this kind of webinar every few months to especially post result. It's always interesting to understand what's happening in the market, the earnings, and the macroeconomic scenario. So as I mean, all of us are fully aware of what's happening in the world in terms of geopolitical tensions, trade war, physical war, macroeconomic headwinds. And in spite of all that, the markets are resilient and very strong liquidity into the market, is largely participated by the retail through mutual fund. So I'm not spending time to delve into each of that area because all of us, I'm sure that are fully aware of what's happening on the real-time basis. So straightway, I think I'll come on to the business. That's the Green Lantern, the status, the earnings scenario, and the outlook as we see forward. So to take you first is that we are fully aware at Green Lantern Fund Management team the current cash position in the portfolio, and we are definitely working to deploy this capital as we see opportunities coming across us. I mean, especially meeting our investment criteria based on turnaround stories or improving earnings, revenue visibility. And from here onwards, we are actually looking to build a portfolio with at least 2 to 3 year time frame in terms of reasonably good reward for the investors. This is little different than what we have seen in the last cycle, especially between 2020, 21 to 24, where the earnings momentum and the reward momentum in the market was very, very fast. So going forward, we believe that this would be not at that pace, and therefore we need to have portfolio which should provide us at least a substantially good return over at least 2 to 3 year horizon. So to take you a little back in order to understand why this scenario in the portfolio is, then let's go back to early 2024, where probably I think we were fully invested. And as we move towards mid 2024, September, October, we had few stocks where we were invested at multiple returns and became very expensive in terms of the way we analyze these businesses and the way we analyze the valuations of these businesses. At the same time, around that period, we were finding very difficult to really find good investment opportunities, which meets all of our criteria, which we have seen over the last 5 years, that how we identify businesses and invest into it, and especially what we look on the downside, which in terms of the risk reward parameters or margin of safety. And then finally, you have also seen our way of finding various sectors, various companies in the sector, and the kind of performance we have seen between 21 and 24. So keeping that in mind, we were finding very difficult to get even really good businesses with attractive valuation where one can like to invest during the mid of 2024. We also uh, observed that the market was very expensive. The broader market valuations were very, very high in that phase, and especially which were reflecting the valuations one would give subject to the revenue growth and the earnings growth of those businesses should be about 25% CAGR for next 3, 4, 5 years, and which is very difficult to justify. So the market was very expensive, we felt at that time. And simultaneously, you all must have observed that there was a flooding of IPOs at very high valuations, and these IPOs were getting listed even a further higher valuation at that point of time. The supply of paper was increasing. The QIPs were coming. I mean, we have seen across that period, number of QIPs were being offered by many companies. In fact, it was very nicely said by someone that the capex cycle in the country was getting funded by the retail investors. So that's the kind of scenario. And simultaneously, we also observed that a lot of OFS was coming and promoters were taking money at home. So this was also a little concerning phase at that point of time. And then we observed continuous selling by FIIs, which we have seen almost more than, I think, 3 lakh crore of kind of money have been sold till March, February, March. And on the macro side, when you observe, we felt that the export growth was not good in the country. We were practically flat for 3 years. The earnings, salary, wage earning was not growing. The infra spent by the government was also slowing down. So keeping in line with all this, we felt that the hypothesis with which we were invested and simultaneously the valuations which market was giving, which we did sell some stocks in the portfolio around that period, and which has actually resulted into the cash position since then. Uh, Post Trump and around March, April, we saw a little different positioning. And post the first salvo of Trump tariff war, and then the kind of yo-yo or volatility which he has shown in terms of the percentage applicability of tariff, I think market somewhere there made a panic bottom and bounced back. Now, what we observed is this bounce back happened very fast, A. It has happened in a lot of stocks which we were holding and we had sold at very high valuations. So for us, it was no point in repurchasing those stocks purely because it could have been a momentum play. Whereas our hypothesis is always to find a very reasonable valuation while even at entry point. And we don't want to buy something which we believe has a greater full theory to exit, and somebody will give me exit at a higher price. That kind of risk we don't take in the portfolio. And therefore, we did not participate in that kind of rally and continue to look forwards opportunity as what we have experienced and learned over last many years towards investment strategy. So that's the reason that our cash position remained more or less similar in spite of the market bounce back. But as we go forward, I think what we are looking at is that we are observing some positive signs, and therefore probably you would observe that we have started investing into the portfolio, especially into the stocks which we feel which meets our criteria in terms of revenue growth, earnings growth, and very favorable valuation. Although these valuations are always relative today because of the kind of liquidity we are seeing in the market. And we are also investing, keeping in mind the current global scenario in terms of tariff war, probably the penalty which would come because of Russian oil purchases, uh, slowing of European economy, headwinds to our economy, uh, especially coming from tariff and through tariff, including the IT sector, the textile sector, the auto component sector, and increasing. So keeping in mind of all these things, we are trying to realign our portfolio, keeping all the time that we don't dilute on our risk reward parameter. There are few positives which could probably we look upon as the ending of Russia-Ukraine war, which could probably be a good trigger. Second is if that happens, and there could be a possibility of election in Ukraine, which could result into eventually a redevelopment and rebuilding of entire Ukraine, could be a large opportunity for the world. And third, we believe that, especially from Russia, Ukraine, the dialogues through Trump, the US, is we believe that probably President Trump is more getting aligned slowly towards no war, physical war in the world. Though his making America great again philosophy will continue, and that could create a trade war, and that could hurt many sectors across the globe. That could probably force the world to relook at the supply chain system across the globe. And all this will do take some time, but at least directionally, what we feel that we need to keep all these things in mind while designing our portfolio over a period of 3 to 5 year outcome basis. So, and lastly, we are also aware that what's happening in terms of the Q1 results, what kind of earnings growth we have seen across every sectors, and what kind of consensus analysis which is coming out for every sector. So, in keeping all this in mind, we feel comfortable that we should be able to deploy our cash positions as we go forward. And I repeat again, with at least 3 year kind of a strategy in the current environment. However, all this we know is subject to the stability in geopolitical situation and some reduction in the tariffs, which we feel if this war subsides or gets over, then probably we may expect some dilution from US in certain area. So keeping all these things in mind, we feel that as we see forward, we would be able to invest slowly into the, and we are seeing some opportunities on the table, which we would definitely participate in. So with this in mind, I'll before I hand over to Abhishek to talk more on the strategy going forward, I thought that let's even share what Pradeep has in terms of earnings observation during this season, especially Q2, and the outlook going forward. And thereafter, we will go detail into the strategy. And after that, I think we'll follow Q&A where we can cover larger topic. Thank you all for joining, and I request Pradeep ji to talk on the earnings.
Good afternoon, friends. So I'll just briefly take you through the earnings season just gone by. If you look at the earnings for the Nifty 50 companies, the sales growth was only 6%, EBITDA growth was around 5%, and PAT growth was around 8%. If you look at the broader universe, the NSE 500 universe, again, sales growth was low at 5%, EBITDA growth was around 11%, and profit growth was close to 10%. However, if you look at the sectors which showed good profit growth, they were sectors like oil and gas, especially the oil marketing companies, which showed a very high profit growth. Cement again showed very good profit growth, and chemical companies and media companies again showed good profit growth. Then within metals, the steel companies had better profit growth on the back of imposition of that protective anti-dumping duty. But the bigger sectors of the market, such as banking, consumption, IT, auto, and pharma, all these major sectors had much muted earnings growth. And even in the profits, we saw churning of, sector churning. We often talk of sector churning in terms of market performance. If some sectors do well in a period and then they sort of fall back, and some other sectors keep up. But in profits, we have seen this time similar experience. So the leaders of FY25 in terms of profit growth, which were definitely the capital goods industrial sector, real estate, and and power, the energy and power. These sectors are showing moderation in profit growth, and definitely some moderation in order books for industrials. Whereas cement and chemicals, which showed, which had very weak earnings throughout uh, last 1 year, are showing good earning growth on the basis of on the basis of a weaker base. Uh, if you see the Nifty consensus EPS, it continues to get downgraded. This quarter, after this quarter's release, the consensus EPS of Nifty was downgraded by another 2%. And total downgrade of our Nifty has been over the last 1 year has been close to 10%. So consensus EPS for Nifty for FY26 is around 1100 rupees, which is showing just an about 8% growth for FY26. And at 25,000 Nifty, we are trading at around close to 23 times, 22.7 times FY26 EPS. FY27 EPS consensus expects growth to be at 17%. But we'll have to see how that goes along, because even the absolute number of FY27 EPS has got downgraded, as even the base of FY26 has reduced. Uh, Another note in terms of results, another noteworthy feature is the aggregate salary bill of NSE 500 companies. The expense of salaries on the account of salaries and wages, which will be the income for most of the population, and which will be a key input for consumption growth. Aggregate salary bill for NSE 500 grew by only 7% YOY, which is very similar to its growth in FY25 of 6-7%. And so this is just barely keeping with broader inflation and leaving less money from a discretionary consumption point of view. The good feature is, while sales growth has been weak, margins have been relatively stable. Companies, in spite of weak growth, have been broadly able to, and an aggregate level, broadly able to hold on to margins. If you just look at the broader consumption, like if you take domestic investment related sectors, cement companies showed good profits and good margin improvement on the on the back of slight price increases and raw material or energy costs remaining weak. Whereas power sector was results were not that great. In the industrial sector, the power capex related companies showed very good growth, whereas the broader corporate capex related sectors, say companies like Thermax or ABB, were not as impressive as compared to a GE or Nova or Hitachi Energy sort of companies. In the consumption sector, I think margins were under pressure. Demand, we have seen some improvement in the rural sector, but urban demand continues to remain weak, which we have seen even in domestic auto, whereas international auto has suffered more damage because of the weakness in the global auto demand. Overall, export-oriented sectors are witnessing lower growth, which was very evident from the commentary of IT sector also. Whereas in the banks case, BFSI case, I think most of the lending institutions had reported weaker results. The banking sector in particular, name pressure continued, and credit costs have shown some uptick from very low levels of last 2 years. In the non-banking space, the results were mixed because some companies, particularly gold finance related, did show better, but vehicle finance as well as consumer finance related companies also showed weaker results in terms of slightly higher increase in credit cost. The credit cost is increasing from a low base, so it's not alarming at a system level, but it is definitely impacting the profitability and expected profitability of these companies. So that's the broad picture, the broad backdrop against which we are, making our portfolio strategies. And to speak more on that, I think I'll hand over to Abhishek on this. Thanks.
Hi, good afternoon, everyone. I hope I'm audible. So I think, and thank you everybody for joining us and kind of trusting us with your money. We understand the responsibility and we'll try and do our best with that. So Pradeep ji has outlined the recent results really well. The only thing that I wanted to point out here is that in last 4-5 years, for continuously for 3 to 4 years, we have seen an earnings upgrade cycle. So we saw analysts continuously upgrading numbers from FY 21 to 22, 22 to 23, and then for 24 as well. However, since last 1 year, we have seen stagnation. And now, as Pradeep ji also pointed out, we are seeing across the board downgrade in earnings. But however, having said that, the valuations have not corrected in line. So while we are seeing downgrade in earnings, we are not seeing the corresponding reduction in valuation across the board. So that's one thing which kind of makes our job as portfolio managers who are value conscious, who want to invest with margin of safety, who are focused on earnings growth, but pay the right kind of price for that. It makes our job a little bit more difficult, and that's one of the reasons why you have seen us taking a little longer to build the portfolio here. So I just wanted to point out that from here on, we've seen a lot of sectors which have done well. And earlier, we were doing a lot of top-down investments as well, where in the past we identified cap goods very early in the cycle. From 2019, 2020 itself, we were positive. We saw some pain in the initial part of 2020, but thereafter these stocks did well. So when you identify certain themes and sectors a little early, you have to go through some pain, whether it was Jindal Stainless or Elecon in 2019-20 that we invested. We had to go through some pain, but eventually these investments turned out to be really good investment, but we took some pain. So when you identify some new stock or a sector where there is value, few quarters may you may have to bear with the business company for few quarters before the earning kicks in, or you can conclude whether your hypothesis about that business and management is right, or you have made a mistake. So that's one thing I wanted to point out. Since a lot of sectors have done well in the portfolio, what we are trying to do now is either investing at a micro level in sector, subsectors basically, or it's more of a bottom-up opportunity. So while we may not be, say, very positive on given where valuations are on the overall capex theme, we still are positive on few businesses where we believe that there'll be earnings acceleration in the next 6 months to 2 to 3 years. The earnings will keep on kind of accelerating, and we should see an upgrade from investors, from analysts in some of these stocks. Or some businesses which are more rural or agri-related, where a general slowdown may not necessarily impact, or where lack of export opportunities or uncertainties regarding exports will not impact these businesses. So these may be businesses which have invested over the last many years, but are yet to see a impact of those investments in their earnings numbers. or some auto ancillary opportunities where we find that given the push that government has done on the consumption side, which is from a cut in income tax rate, the talk of GST rate reduction, or the steps that RBI has taken by reducing the CRR as well as reducing interest rates. So some of these stocks may find support. Along with that, maybe some of the recent additions are those where we believe that market is kind of misunderstanding the technological change potential, and the business eventually should see a significant re-rating. So those are the things that, I mean, so there, I can talk more on how we are thinking about portfolio, but basically the point I want to make here is our focus remains on identifying opportunities which over a period of next 2 to 3 years should have visibility. As Nilesh Bhai pointed out, while we were very early, some of the things which have done well, where we missed out in the very recent past, in the last 3 to 4 months, has been, say, for example, power sector. Now, we were very early with power sector, and we made our first investment in a power sector company, which was Techno Electric, way back in November of 22. Then we added more names like GE T&D at around 130, 140 rupees. We added Trill. We played other companies within the sector, number of other players in the sector. And as valuations became expensive, we started exiting starting July of 24. And while some of these stocks corrected, we felt that there'll be only a bounce in these because near-term earnings remain strong. However, so when we invest, we also try and understand the basic characteristics of the business. So while we were very positive and we remain positive on the sector, what we understand is that while demand may remain strong in some of the segments within, say, since I'm giving the example of power sector, supply can come up very fast in the sector. And we believe that over a period of next 1.5 years, supply may outstrip demand, leading to normalization of margins, which have seen a significant expansion. So with that as background, for us, it was a little difficult thing to play for just a bounce and something that we kind of decided not to. And we thought that we would rather play a longer game where we identify businesses which may see a better earnings potential over a relatively longer period of time. While it may mean that we may see a short-term pain because any new investments will have to give it time to kind of come to its earnings potential level or to showcase its because we are early. Usually we are early before a lot of investors have jumped in. So there can be a time lag between when we buy and when the market recognizes or when there is a earnings growth rate witnessed by the company. So those are the thoughts around how we are trying to build portfolio. We are finding some opportunities on a bottom-up basis, just that we are taking a little longer given the overall uncertainty in the environment, the kind of news flow that we are seeing every other day. We are taking a little longer, but rest assured, we are cognizant of the fact that we have to capture these opportunities. Just that we want to tell investors that this portfolio and the scheme is more longer term oriented. Our investment philosophy kind of we think about businesses and business cycles. We prefer being early in a business cycle and like to play it as long as we believe that the market has not overpaid for the potential growth in earnings. So with that, I'll kind of stop here, and maybe if somebody wants to add, Nilesh Bhai, Pradeep wants to add, they can add, or else we'll open the forum for question and answer session.
So we have a question which is related to our cash position and how we are going to utilize, though you have touched upon that. But if you have a specific to add on, if you can share your thought.
As I pointed out, so it's a stock specific approach that we are taking. The cash deployment may happen faster if there is a correction in the market and we find opportunities or for some of the names that we are working on and that we like. So typically what we try and do is start with a smaller position, and as we gain confidence or as we find better value, we add to the position. So if there is some correction, the deployment may be faster. Or as we gain confidence in some of the names that we have been working on, then the deployment will happen faster. But yes, we will continue to invest as and when we find the right opportunity. Our default position, as we have a number of times stated, is cash, but not the kind of cash level that we are holding as of now. So we would like to invest, and we are continuously looking for the right risk reward.
Another question is related to Trump tariff policy and how it is going to impact our relationship with India, our relationship with US and European countries, and what's the impact we see on our portfolio companies.
So it's a very tough question and very difficult to answer what President Trump has in his mind and what kind of real businessman strategy he is applying to. But having said that, yes, India is probably, we feel that we have missed some gaps in continuing the old relationship and would have actually avoided or prevented this kind of tariff, and on top of that, a penalty tariff for especially Russian oil. So what, as I said in my little brief, is that what we are trying to, instead of predicting what's going to happen and how much tariff and etc., we know there are relative variations in tariff with respect to other countries. We know where our country has a larger export especially to US, and how it is going to impact those sectors. So uh, fundamentally, what we are trying to do is that as far as creating and understanding the revenue or business visibility, we would try and find businesses which are a bit independent of all these happenings, and focus more towards currently at the domestic angle of investment. There could be few investments we would have in the portfolio prior to this Trump winning the election, and would have some impact because of this tariff. But apart from that, I think the new investments, whatever we would look at, we are largely trying to uh, like figure out those businesses, especially in line with the domestic demand. And we are seeing some of this coming across the table. So this is more on the tariff side. What is the next?
What can happen with our portfolio companies?
Yeah, so bearing one or two stocks in our portfolio, I think other stocks are not too much impacted because of this tariff scenario. And the future investment, what we would do at the moment, we would, irrespective of whether the physical war between Russia and Ukraine gets over, and overall we see stability in the global economy, and then the global economy work towards rebuilding Ukraine if happens, or uh, getting back to the business in terms of economic activity, the tariff would remain. And therefore, the businesses, as I said earlier, will have to realign their supply chain management. So we will keep all these things in mind while investing into the companies, so that our impact from this tariff war is probably minimized or nil.
We have few stock specific question stocks like GE Vernova and Hitachi Energy, given the rally they have given due to strong results. Is the rally going to continue in these companies? Sir, if you want to answer.
You want me to answer?
Yeah.
Actually, as a practice, we would not like to really comment, especially whether the rally will continue or not. This is because we all know that the kind of liquidity which is coming in. And I think all of us, all of you also are very experienced that a huge liquidity inflow many a times do distort valuations for a longer period.
I think Nilesh Bhai's audio was not.
He's back.
Now. Yeah. I think some internet issue. Can you hear me now? Sorry, guys. So, I would not really comment whether these stocks will go up further or not. What I can only add on is, or give us some observation which as investor people should be aware of is one that, as Abhishek pointed out, the capacity creation in these businesses, especially on the transmission equipment, which includes circuit breakers, transformers, etc., is not difficult. People who have technology and vendor qualification to create an additional capacity is not at all difficult. And we have seen in the past that the capacities can come within 6 to 8 months' time. And in fact, we are seeing many companies, including CG Power or everyone, is expanding their capacity at a very fast pace. This is number one. Number two, some of the projects which orders have come, especially on HVDC side, these are a very long drawn project. So it's not that the revenue at the pace at which market probably is looking at or is going to come overnight. It's going to definitely be staggered over a period of years. Number three, we see a lot of volatility in certain decision making, especially from the US. Like all of you must have seen a tweet today, and I think suddenly US has put solar and wind energy under approval process before anybody going and executing or putting up those projects. Now, if renewable is taken on back burner in US, then probably a lot of orders which market is factoring going forward in transmission area can immediately put on hold or may the new orders may suddenly slow down. And therefore, irrespective of whether current order book gives them 20%, 25% growth rate and the margins which have come very high, probably these are not sustainable. So there could be a sudden change or reduction in the order book, or I would, as we normally speak in our among us, is that second derivative of order inflow, that is rate of change of order inflow. If that starts declining, I think market to value these businesses on a revenue multiple, it's one needs to be very cautious and be alert on those fronts because of current volatility, uh, the kind of thinking which President Trump has towards renewable energy. Europe was the pioneer in pushing renewable energy, where Europe economy is slowing down. So all this can, and simultaneously, massive capacity coming in terms of production of transformers, circuit breakers, etc. One need to be very cautious on valuations as you go forward.
Is from Rahul wanted to understand that what could be the key growth drivers for corporate earning going forward, and how do you see government capex moving in the coming years? Abhishek, can you take this question?
Sure. Right. So the earnings drivers for the corporate earnings growth. So one of the things that I mentioned was on the consumption side. So I think there is some impetus that government is also concerned about what's happening on the slowdown which is happening in the industry. And I think this corporate rate cut, income tax rate cut, then GST reduction that government has proposed, or even what RBI has done, because over last 1.5 years before RBI took these steps, there was a lot of tightening, financial tightening that Reserve Bank had done. So that has kind of reversed. So those will support the consumption part. If the consumption picks up, and this is something that we are somewhat positive on, that there will be some green shoots on the consumption side. We are already seeing some green shoots on the rural consumption. With some of these measures, there could be some increase in consumption on the urban side as well. If that happens, that we may see a revival in private corporate capex. So if we hear what L&T chairman recently pointed out, and from their order book as well, so he pointed out that private capex has started to pick up. Now, if that capex, so far, most of the investment burden was taken up by the government. Now, if private sector capex also picks up, supported by the demand side, consumption demand, I think it should impact a good part of the investment universe, listed universe of companies. So those are the things that we are looking at. And of course, the usual factors, which is monsoon, how our export environment shapes up, if this overhang of duties, extra duties by US goes away, then that will kind of bring things back to normal. Otherwise, it remains an overhang. What is a concern now is over last decade or decade and a half, IT sector employee addition has been a big supporter of everything from consumption to housing demand, etc. And we have seen a significant weakness there. So new job creation in a large sector like IT has kind of reduced. So that's one of the concerns that we'll have. Secondly, I think since government has decided to give away a lot of money in the hands of people, so what they're essentially doing is, whether state governments or central government, they are giving more money in the hands of people through schemes like the Ladki Bahan Yojnas or the income tax reduction, etc. Their ability to fund capex will reduce. So that's the flip side. And so those are the things that we will watch out for on the earnings growth. There are some factors which make us positive. There are a few things that we are watching, particularly on the export side, as well as how the private sector capex further picks up.
We are getting questions like, are we planning to get into AMC business, launch SIF funds and AIF? No. So we don't have any plan to launch any SIF funds as of now. But yes, AIF fund can be planned, and we are thinking on those lines. Maybe in next few months or 2-3 quarters, we can discuss about this. And we will definitely inform everyone. Which are the sectors we are looking, if we are comfortable sharing, which are the sectors we are looking to incremental build position, or is it going to be pure bottom-up specific approach?
Right. So I partially answered that earlier. I think mostly it'll be bottom up. However, there could be subsectors within that. So a certain segment of say cap goods, we believe could do well. So we may play that, or certain part of consumption theme that we may be positive or we like. So we may look at a few companies there. But mostly, I believe as of now, it seems like it'll be more of a bottom-up stock approach.
Yeah, so as Abhishek said, there would be subsectors. For example, we all are aware of a lot of electric vehicles, and that is still going on. And day by day, there is an demand change is also being seen. But simultaneously, on the renewable side, now we have pushed a lot of renewable power generation facilities coming up on solar and wind. But then to link these facilities to provide power whenever required rather than not when it is being generated. So there is a something like now government is proposing that there could be a separate concession for someone putting up the battery storage. So this kind of subsectors can be seen in terms of finding opportunities, in terms of who can provide this battery packs or battery storages. What is the technological change which is happening in this area? Who would be the earlier beneficiary and whether there are listed players available? So, so we look at, and similarly on the agro side, as you said, yes, we need to see some businesses which are independent of, uh, say, tariff or even the GDP growth rate, as long as there is good monsoon. So something like this we are seeing, uh, and the top bottom up is definitely available to us as we are seeing currently. The other area, like maybe I can add one more, is that everyone is aware and everyone is, in fact, in the entire industry street is positive on the CDMO side. So then one can find out who could be the better placed in CDMO or who could have a better balance sheet and return ratios along with CDMO and other API businesses. So those kind of subsectors within the entire pharma space one can look for, and then find bottom up businesses uh, uh, which are really available at good valuation. So this is how we are working to find stocks in the portfolio.
Sir, if we can share about rural consumption picking up or due to income tax reduction and GST cuts?
Gokhale.
So we have seen some pickup in rural consumption. In fact, the commentary from most of the consumer companies is that rural has started to pick up while urban demand continues to remain weak. And part of it is also due to the fact that as Abhishek pointed out, that incrementally from the state governments, a lot of expenditure has being spent on the welfare schemes. As also, I think this monsoon is good, so that should provide a decent. They should provide some pickup in rural consumption, which has been actually lagging since quite some time. So we should see some pickup and some opportunities. We may have to we are looking at it, but the broader on the consumption sector we have to see because a lot of unlisted spaces are also taking up a larger pie of consumption, and one reason for weaker listed consumer companies growth is also due to that. So but on the rural consumption, there is a possibility of a pickup in the rural consumption. So more rural oriented place can benefit from that actually.
What are your views on market related stocks like AMC, exchanges and depositories, as it is forming a big percentage of other PMS holding? Pradeep sir, would you like to answer this?
Yeah. So I think market related stocks continue to have, in fact, within the banking or by BFSI space in general, they have done continue to show good earnings growth. But we are aware that these, I mean, uh, at the price points and in terms of the incremental headwinds, in terms of further penetration of growth in these, because a lot of these the market related stocks, the revenues are based on the derivatives, and there is clear intention uh, on the part of regulators as well as the government that this market should not resemble some sort of a uh, casino, and therefore incrementally restrictions are being put on the derivatives trade, and a lot of income is being generated from that part of activity, which has seen very explosive growth, particularly post COVID. At this point, we would not be very uh, keen on those stocks, because the earnings are very volatile and are very directly attributable to underlying market activity.
One interesting question we have, can market pressure can cause us to deviate from our core investment principle, or we are going to stick to our margin of safety concept?
Yeah, so very interesting question, and thank you for asking this. I don't think so, because we have seen, all of us at Green Lantern have seen many cycles in the market. There is a saying in the market which you all, I'm sure, are fully aware of, is that the liquidity and with that, the market can be irrational for a much longer period of time till you become insolvent. So we are aware of that learning and experience in the market. There is always going to be some distortion because of liquidity, but eventually we have also seen the mean reversion happens over a longer period of time. Either there could be a very long time correction, and eventually the valuations resembles to a reality, or there could be a price and time correction. Both happens, or like COVID, we had a price correction and not the time correction. So anything is possible, but this will not force us to buy something. And that is what I said earlier, that we are not momentum players or investors with the belief that somebody will relieve me at a higher price. There is a possibility, like if you are good in momentum, you can buy and then you suddenly see 20% up or 30% up in the market. But then are we going to sell at that price? Will our investment hypothesis permit first level to buy? And if we have bought with momentum, then we have to sell at that point. So this is not very easy to trade. There are players who could be smart enough to do that, but I don't think our DNA would allow us that. I mean, we cannot sleep at all. That if you buy a stock purely at extreme valuations without cash flows, and still you have Excel sheet which is showing a stupendous growth, but no cash flow for many years. If the stock is available at a very crash market scenario, possibly one can look at, but not when the market is almost at 25,000 Nifty, 23 times FY26, FY27, 17 percent growth, which is very challenging. I mean, how someone arrives at 17%, I just don't know. But fair enough, that's what the market is looking at. So if as we come closer to that, we will also define and figure out that where how it is unfolding. But as Abhishek explained in the earlier, other than the consumption area, that too basically you are creating out of fiscal spend. But you have no capex which is happening on the infra side or in many other areas. So We need a productive asset and productive capex in this country, and not the consumption-led recovery, which could be like we say the future earnings or future cash flow is being spent today. These are concerns which needs to be addressed, and therefore, keeping all this in mind, we will not be able to play that momentum or relative pressurized game. And we will stick to if seeing the business opportunity or earnings revenue growth based on some new developments in the company, and that's what we will continue to do.
Just a very, very small point. I think what Nilesh Bhai is saying also comes from our experience and the fact that the last 20 years plus that we have spent in markets, we've always been able to find risk reward businesses which were trading at good risk reward. So there may be a period where we are not comfortable, but this situation may only arise if market continues to move up. We feel reasonably confident that in that environment we will be able to find businesses which still kind of meet our risk reward. As I've pointed out, we are already seeing some companies. And if that situation, as in the good markets, persist or remain, then the businesses that we will buy will also be rewarded by the market. So I don't see a situation where we'll have to kind of leave our investment framework, change our investment framework, and chase momentum. So this comes from our confidence that we understand businesses, and we will be able to find out or select businesses which will kind of benefit from that environment.
So if you see our last 5 years journey also, the probably early 2020 we were really sort of absent in terms of participation. We could not figure out what was happening because of COVID, the vaccine coming, not coming, money printing and distributed by US and Europe across businesses and the people. But as Abhishek said, with some ability or experience curve we have in terms of sectoral identification, stock picking. Post 2000, I think second half of 2020, our journey has been good, and this is what we feel that there could be these kind of transitional phases where we would like to be cautious, and we're okay with some cash holding. But as time comes, as visibility improves, I think we should be able to work hard to deliver a good return.
We have I think shared our thoughts very clearly, and more or less we have answered every question. And so any point, Abhishek or Nilesh, if you want to share as final remark?
Yeah. So what I want to share is that we all are aware and observing that market is really resilient, and in spite of very heavy, lofty valuations in many businesses, many stocks, many SME IPOs are still getting oversubscribed without any probably due diligence, or really not great businesses at really high valuations. Lot of IPO suppliers have started coming in. Again, QIP and OFS has been happening. Even today, one OFS was there, almost 24% equity of a company. So we are seeing a huge supply of paper from promoters, from new IPOs coming in. And at the same time, we are seeing a massive liquidity inflow through SIP or lump sum money coming into mutual fund. And all this is probably giving us a kind of a feel that everything is really super good, which in reality, we all know that there are massive headwinds globally, internally, and capex cycle is slowing down. The wage earning, as Abhishek said, on the IT side is slowing. Even I believe, even a lot of sectors and corporates I was talking to them on one-on-one basis is also the wage salary increase is not happening. So keeping all this in mind, what we only would say that we need to participate with a lot of caution and ensure that our risk reward is very favorable, and give yourself time to judge the turnaround over a period of time, and buy only if you have those kind of safety net around that stock or the portfolio. And I think we will continue to do that. So that's what from my side, and I really thank you all for joining us on this call. Any more questions, for sure, you're welcome, and we can definitely address separately as we go forward.
For trusting us and joining here for this webinar. And if you have anything specific, you can mail us also, and you can get in touch with us at glc.operations@gmail.com or at my mail ID nitin@glcapital.in. Thank you so much, and have a nice evening. Bye bye.